Hello and welcome back to our marketing, sales, collection, and accounts receivable module. In this video, we're going to discuss the risks and controls related to cash collections and the accounts receivable process, or the AR process. Cash collection involves receiving cash from customers, depositing that cash, and then recording the subsequent cash receipts. The collection process is also known as cash receipts process because it increases the amount of the cash line item, which is the most liquid of the current assets on the balance sheet. Activities that impact the financial statement. So as we know, in the statement of cash flows, we have three different types of activities: operating activities, investing activities, and financing activities. Operating activities involves receiving payments from customers for the goods that were bought on credit. So the impact is that these cash receipts would increase cash and reduce the accounts receivable balance on the balance sheet, so both on the current asset sides. And if we remember, the balance sheets is assets equal liabilities plus owner's equity, so this transaction would just affect the asset side. So this increases net cash flows from operating activities on the cash flow statement. Investing activities, a business event might include selling used machinery and equipment for cash. So this would increase the cash balance and then decrease the machinery and equipment balance, a fixed asset, on the balance sheet. Again, we would have an increase in net cash flows from investing activities on the statement of cash flows. And a financing activity might be the issuance of 10,000 new shares of common stock. So this would increase cash and common stock, which is equity. So this part of our accounting equation on the balance sheet. So this would increase net cash flow from financing activities. Receiving payments. So the most critical part of our sales and collection process for accounting professionals is to understand the collection of payments. The method of payment collection depends on how the customer purchases the products. So payment methods and some examples. As we've discussed previously, we might have a B2C, business to consumer cash sale. At the time of the sale, a consumer might walk into Starbucks, for example, place an order at the counter, pay at the register, and then voila, get their coffee immediately. We might also have a cash sale, also B2C, business to consumer, but before the sale. So another one of my favorite activities is when I buy from Amazon. So you would purchase, and at the time of the order, even though the items sold have not been packed or shipped. So obviously we know from our previous lesson in financial accounting, this is classified as deferred revenue on Amazon's record. So it is a liability until Amazon transfers that ownership of all of those items that I bought on Amazon to me when they actually ship it. We might also have a credit sale from B2B, which is business to business, and this payment of timing might be after the sale. So a customer pays for the Amazon purchases at the time of the order, even though those items sold obviously has not been packed or shipped yet. So we still have a deferred revenue until the actual shipment takes place. Then we have control activities around cash receipts. And as a former CFO, I always start off with the CFO as the control owner. So as a CFO, you might segregate authorization responsibilities for accounts receivable, cashier, cash receipts, accounting sales, credit approval, the bank reconciliation, and even the reconciliation of the subledger to the accounts receivable control account. Then the actual treasurer might conduct like independent reconciliations of the subsidiary ledger, or they might ensure that every receipt has a traceable audit trail and is uniquely identifiable, or they might physically count cash and compare the actual cash with the accounting records. Also, the treasurer might implement a lockbox system, we will talk a little bit more about. They might also prepare a daily remittance list upon opening the mail, and then restrictively endorse checks and then deposit checks daily. Additionally, we might have the controller that might do automated calculations of discounts. Bank deposits. So a lockbox is a post office box that can only be accessed by a company's bank. So the bank collects the checks daily and puts them into the company's bank account and then sends the source documents to the company electronically. And there are 3 source documents that are typically sent. One is all of the remittance advices explaining the payments that the customer made. 2 is a bank remittance report for that day that lists the checks that were received from the customer. And 3 is a deposit slip as proof of the amount that was deposited into the company's bank account, with the amount of the deposit equaling the total on the bank remittance report, which was number 2. So here you see a visualization of electronic funds transfer, EFTs, and lockboxes. So we see here, we start with the customer who makes a payment, and then instead of that payment going to the company, we see that it is circumvented and it goes directly to the bank via a lockbox. Then the bank provides that remittance report and deposit slip to the company. So this allows customers to submit payments directly to the bank, removing the risk of error and fraud related to that extra step of the company processing payments and then sending them to the bank on behalf of the customers. So now let's look at cash deposit control activities. Again, we have the treasurer as our control owner, and they may implement EFT, electronic funds transfers, directly to the bank via a lockbox system. They might also conduct regular independent bank reconciliations with management's review. Now let's talk about recording cash receipts and the control activities there. Let's focus on the controller as the control owner. So the controller will mail monthly statements to customers and investigate and fix any discrepancies that are reported. They might also mail these monthly statements and as a risk, like as a control activity against recording cash receipts to an incorrect customer account. And here we see the collections process flow chart. So we start here with accounts receivable, and then from the customer to the bank to the treasurer and corporate accounting. So these are the steps and control activities in this flow chart that shows the collection process for credit sales, for example. And that concludes this lecture video. Thank you for watching.